Okay. This exercise is about how to apply the dividend discount model. So we have some information in the exercise text, and I want to write these down. So info. The first information we get is that Furniture House just announced it will cut its dividend from 3.8 to 1.25 per share and use the extra fund to expand. Okay, expand. They want to like change the company, like to get more money within the company, so they can use that money to actually make the company bigger. Prior to the announcement, Furniture House's dividends were expected to grow 3.2% rate, and its share price was 35.12. With the new expansion, Furniture House's dividends are expected to grow at a 5.4% rate. Okay, so what we got out of that was that they are changing the system. So we have an before and an after. Before, the dividend was 3.18, and after they will only pay out 1.25. However, the growth rate will increase from 3.2% to 5.4%, which is interesting because we want to find the best solution. Like, what will happen with the stock price after the announcement, and we are in all the assumptions, like all our results are based on that we are in the strong form of an efficient market where all information is public, and so every so the stock will change immediately after an announcement. And we know from the dividend discount model, where with a constant dividend growth model, like the constant dividend growth model, we have the price, which is equal to the dividend year one, like divided by the expected return to equity, like what the equity holders expects to earn from this stock. So what we need is the respected, because we have like the price of the stock before the announcement. Share price was 35.12. So we have the price of the stock, the growth rate, and the dividend the dividend of per share. Sorry for my brain not being so good there. So we can just rearrange this formula so that's, and would we do that? I'll just do the algebra so you understand the process. That would be dividend divided by the price plus, because then this is alone, and then we just need to plus the G, then we get the expected return to equity or to the shareholders. And then we just find our Excel sheet. I've just illustrated the formulas here, or the information from the text is the same text, and we just do as we just did in the algebra. We had the dividends divided by the price of the share, was it plus the growth, which is 12.25%. Yeah. So the expected return to the shareholders would be 12.25%. Then we know what they expect. Then we can calculate if this is a good idea or not, and we have the numbers. We can just continue using the formula from here with the after the announcement. Yeah. And then just plug the information in, because after the announcement we know that the dividend is going to be 1.25, and the expected return is not going to change, because they are still expecting 12.25%, and if they get more, the value of the firm will just increase. But will it increase with this new way where the furniture house is trying to make the investors or the shareholders more money by like keeping some of the cash in house? And if we calculate that, we find that the price after the announcement so we had the dividend, the new dividend payout, the return on equity, and the growth rate, the new divided by this, and it's because it's in Excel, so you need to like make these around the and then you see that the stock is going to fall by a lot, actually. And we find that price will fall to, which is actually quite a lot. Let's make a 6 here. So instead of 35.12, the stock price will fall to 18.236. Is the expansion a positive investment? No, it's obviously not, because there is the same amount of share outstanding. We have no information about that, so the price, the NPV, the effect of them, the value it creates or actually takes out of the company by this new by these new changes would be, we need obviously to have before and after, which is no, after. We need to find what is going on after compared to before. So this would be the NPV would actually fall by 15. Whoops. So obviously a minus. Whoops. I'm messing around and I'm making the same mistake. It should be this, the price before, no, the price, what did I just write? After the changes, minus after, this is after, like that, 6 minus 16. So what share price would you expect after the announcement? Okay, in a efficient market where all public information is available and the reaction is instantly, the share price would drop to 18.236 units. We don't know. Oh, it's US dollars. Which will decrease the value of the firm by 16.884 per share in present value. Which, so is the expansion a positive NPV? No, because yeah, I hope that helped you.